Hi, everyone. Thank you so much for learning with us and wanting to understand more about 350 Sacramento and what our organization does. My name is Ashlyn Zettner, and I am the board president with the organization. Before we get into all the learning good stuff, I wanted to tell you a little bit about us and who we are. So 350 Sacramento is a grassroots climate justice nonprofit organization. We have three focal points: advocacy, community, and education. So we are mainly volunteer led. Obviously, our giant team of volunteers is amazing. We have two wonderful employees, Katie McCammon, who is our program director, and Patricia Moore, who is our executive director. And they really make the organization what it is, and they help guide us with all of our different programs and our efforts. And that's why our individual donations mean so much to us. We really appreciate those individual donations and any help always. So thank you so much for watching this, and now I will pass it to our board treasurer, Daniel McCurdy.
Hi, everybody. My name is Daniel McCurdy. In my day job, in the spring, I'm a tax preparer. The whole year, I'm a financial planner. What I'm going to talk about today is some charitable giving strategies that are a little simpler than what other financial advisors might be putting out there, but they might just be easy ways to donate money. To do that, this presentation, we do have some handouts. So I will pass these down. And these will be available online for people that are catching the recording later. And I'll just get started here. In donating, we are asking people to give us money. And so I want to be as upfront and as clear about that as possible. Sometimes we'll be asking for large amounts of money. So before we get into that, let's be really honest about what donating is. Donating, we assume a willingness and an ability for the donor to be able to afford those donations. And at the end of the day, I'll just use the word you, the person and you are giving away your money. So let's suppose a person is in the 33% tax bracket. Basically, a third of their income is going to tax. This would be a single person making about $100,000 a year, a married couple that their household income is $200,000 a year. And they live in California, so they pay federal 24%, California 9.3%. About a third of their money goes to tax. When they donate money to us, they save that third. At the same time, the 2/3 would have been theirs, and it becomes ours. And that's how donating works. And I just want to be completely clear on that. The federal government can make its own money, right? It causes inflation, causes other problems. They can make their own money. You as the individual are not allowed to print your own money. So with that, we're going to speak as though the audience for this presentation has the money, they're willing to give it away, and they have the ability to afford to give it away, which is not everybody's situation. We're going to be covering three strategies. One called the qualified charitable distribution. The next is just naming a beneficiary, and then a strategy of donating appreciated stock. And then a bonus strategy just came about last month with the new tax bill that passed in July. And that is giving away money from your checking account. It's actually probably the simplest way to donate. But we'll cover it. It actually was not available 3 months ago when putting this together. And before going on, I meant to mention this on the last page. When we're asking for donations through a charitable method, we are really looking for $1,000 or more donations. And it's not that our organization doesn't appreciate smaller donations. We have the $100, we have the $50. People donate what they can, and it does add up with enough people doing that to a certain amount. But as we mentioned earlier, we've got 2 full-time staff members, and grants are getting harder and harder to come by. If you're going to take the time to do a charitable strategy, it needs to be worth it to you to not just do it in the August or September or whatever month you do it, but next year when you're filing your taxes, you need to fill it out correctly. If you're donating $100, which would give you a $30 tax benefit, it might come tax time and you forget to do it. Or your tax preparer may charge you an extra $100 to do it. So with all these strategies, of course, they work at any dollar level. But we're really asking for $1,000 or more. That helps us with some of the grants that have dried up. And I think it also just helps overall if you're doing the complication of any charitable strategy to make it worthwhile at that level. So let's talk about what a qualified charitable distribution is. And this is actually, we are talking about retirement accounts. Again, ability to give. If a person has the ability to give, sometimes it's the retirement accounts that are the best way to do that. The way retirement works in the United States and has worked for the last 45 years is people save for their own retirement. When you put money into a 401k or a 403b or an IRA, the government says, all right, we'll give you a tax break for those deductions. But eventually in your life, you've got to pull the money back out and the government's going to tax you then. And that brings up a concept called required minimum distributions. It used to be around age 70. It's gone up to age 73. Another 5 or 6 years, it'll go to age 75. When a person has deferred paying those taxes long enough, the government comes down and says, now we want you to use those retirement funds to pay for your retirement. And the government wants to tax that money. So right now, people age 73 and above who have retirement accounts are required to pull out 4 to 5% of that money every year. And when someone's living on that money, the system works as intended. But a lot of people who have had the ability to save maybe $1 million and are able to fund their retirement out of that, they might have other assets. They might have a house that's paid off. They don't necessarily need to spend all the money they're required to pull out. But when they pull that money out, it looks like taxable income. When you have taxable income, your Medicare premiums go up. Certainly your Social Security becomes taxable if it wasn't. And you go into higher tax brackets. People that have income in the $30,000 to $40,000 range pay 12% federal, or California, I don't have the number at the top of my head. But when you're making 100,000 or 200,000, we already saw that gets taxed at 33%. So you may not necessarily want to pull money out of your IRA, pay all those extra taxes on it just to have money sit there that you don't have to use. And it might be that you're actually donating that money to the charities you care about, to 350. The qualified charitable distribution is an opportunity to forego your required distribution. If that money goes directly to the charity, the check can go to your house, but it's made out to the charity's name. The government says, okay, you've done your requirement, and also, okay, you don't have to pay income tax on that. It doesn't count towards your income. Medicare premiums stay the same, your tax bracket stays the same. If you're such that your Social Security wasn't taxable, it stays not taxable. So it's definitely worth knowing the qualified charitable distribution. If you're in a situation where you're not using your required minimum distributions, but you're required to take them. And since it's not income, you can still take the standard deduction on your taxes. For married people, that's $30,000. Without this, you've got to be itemizing your taxes, which gets into its whole thing. But your itemizations have to be more than 30,000. For a lot of people, donations don't reach that level. When you give in a charitable way like this, remember we said a third of the money was the government and 2/3 of it is yours. You're donating that 2/3, and the government is foregoing their 1/3. Or another way to look at it is you're directing the government to fund that charity. So a lot of times we watch the news, we're not happy with how the government is spending the money from a charitable perspective. And this is more just a thought experiment, but a way you can think of it is you are now choosing what the government is going to fund with that. Now in the handout, the first page of the handout is actually 3 different sections of these strategies. And they're little checklists if you think this would apply to you. And in every one of them, there's an instruction to speak with your tax preparer because people's situations do differ. I broadly said I'm a tax preparer. I did not put out my legal designations. Really, when you're doing these advanced strategies, even the simple advanced strategies, work with your tax preparer, make sure it's gonna work for you the way you think it does. And there's a sentence there of what your intention is. So you tell the tax preparer, I want to do a qualified charitable distribution because I want my money to go to this charity and I don't want to pay tax on it. And your tax preparer can look at you and say, yep, that will work. Or if there is some nuance that it doesn't. That's an important step to take. We of course appreciate the donation either way, but we also want to make sure that you get the benefit that you're supposed to.
Can we backtrack a little bit? So you're giving the example of someone that pays about a third of their income to taxes, but it would of course work if you're not in that high of a bracket. It would just be less.
That's right.
Yeah.
That's right. If your marginal tax rate, which is what this kind of income is usually at, your highest tax rate is 15%, then for every dollar you're giving, you're saving 15 cents. Still works.
Thank you.
Let's go to the next one. So a lot of times when people go to seminars about charitable giving, they really are talking about advanced strategies and advanced strategies for people with $1 million. They're worthwhile to pay some lawyers and some tax accountants to manage that with a charitable trust or various life insurance contracts. Those work and those are out there, but for most people, they're overly complicated. And when we're talking about even $1,000 deduction, those are too complicated. And that's not what we're doing here. And we're not selling anything here. So I just wanted to call that out as something that is there. And there are seminars for that. Financial planners like me put together seminars for those. But there is a simpler way to leave money to charity. And that is just to leave the charity as either a full or a partial beneficiary of your IRA when you eventually reach the end of retirement and pass away. Usually this is just one form from your custodian, your brokerage account. So who you want to leave your stuff to when you're gone, and you fill it in. And you can leave it to your children usually. And when the children receive it, it then gets taxed at their tax rate. So if a person is looking at leaving behind some money, some vehicles, a house, and their IRA accounts, they leave the IRA accounts to the children, but they were planning to donate. Those children are going to pay income tax on the IRA money. So what you might want to do is leave the children the checking account, leave the children the vehicles they can sell, leave the house. But that IRA money is a good thing to leave to a charity. And I don't know, maybe it's a weird dollar amount. Say it's $100,000 IRA and you got 3 children. Leave each of them $30,000, and who gets the other 10? The charity. Maybe it's 5%, leave it to the charity. Of course, the more you leave, the more the charity can do. So you can leave any percentage you want. You can change the beneficiary. The firms that I've always worked at, there's no fee on that. It's just a little bit of administrative paperwork. I've already mentioned that we reduced the tax burden on the heirs. I think it leaves them something that doesn't have that tax liability on it. If you do put 350 Sacramento, you don't have to tell us. And then it just becomes a surprise someday as incoming money. But let's be real. Hopefully that is many, many, many years into the future. And our organization, just like every organization, does not know it'll be here forever. We have a plan. It's in our bylaws that if 350 Sacramento were to go away, the funding we have has to go to a like organization. And if we're not here when you pass away, then there will be some issue there. Doesn't mean the money goes away. In fact, your heirs just have to work with their probate to get that. But we can avoid any complication at all. If we are listed as a beneficiary, let us know. We can have it recorded. If anything ever did happen to this organization, we could reach back out to you and say, hey, go get that form and make that simple change again. Let's go to the, it was going to be the last, except we've got a bonus. So we'll go to the third donation. Number three, donating appreciated stock. So now we're not doing anything that's age-based. We're not talking about your retirement accounts. We're talking about owning a stock, and let's just say that you bought the stock at $5,000 and now the stock is worth $10,000. If you sell that stock, you will have what's called a $5,000 capital gain. You made $5,000 profit on it, and the government is going to tax that probably at 15 to 20%. There is a way for it to be less than that. But for most people, probably anybody thinking of giving money away to a charity, that tax bracket is probably 15%. So of the $5,000 profit, you're gonna lose $700 or $800 in taxes right away. If you give that $10,000 of stock to Sacramento 350, we can sell that stock. We do not have to pay any tax on the gains, and you don't have to pay any tax on your gains. You did a full $10,000 donation of property to 350 Sacramento. That will give you some benefit, right? At the 15%, that would give you a $1,500 benefit on your taxes. So you avoid the $800 tax off the top, and you get a $1,500 benefit. So your $10,000 donation cost you $7,500. These are rough numbers as we're just going through it. Of that same stock, let's suppose you want to hold on to most of it, so you donate $1,000 worth of stock. That works. All the numbers are just reduced. We sell the $1,000 worth of stock. We're not in the business of timing stock markets. We get your stock, we sell it immediately. It doesn't cost us anything. We turn it into $1,000 cash. We don't owe any tax on it. You have a $1,000 donation of property. Now this one, the bill in July did nothing for it because it's property, not cash. So you do have to be in a position where you're itemizing your taxes. Right, so you can avoid the capital gain when you sell it. You receive a charitable deduction for the full amount. You're supporting our organization, because for us, it's $1,000. Might be smarter than selling the stock and donating the proceeds. So if you sell the stock and donate the proceeds, then you're funding the government and you're funding us. If you give us the stock, you're directly funding us. Any questions from the audience?
Sorry, just to clarify, but this, oh, yeah, I see it. It says if you itemize.
If you itemize.
Yeah.
And that's, I mean, we're not doing a lot of philosophy here, but people donate a lot of stuff. And when I do tax preparations, you donate a jacket to Goodwill, you donate property. Is it a $50 jacket? If you put it on Facebook Marketplace, would anybody come by and give you $50 for that jacket? I don't know. Sometimes I think the tax law has gotten simpler in the last few years by really increasing the standard deduction. I think people do a lot of misvaluing when they're donating property. Now, stock, that's a clear amount. There's a market value for it. But yeah, I think the changes in July were good for cash donations. And it might have been a little messy if it allowed property. I'll let the editor decide to leave that in or not. Yeah. Speak to your tax professional about your situation. That is the same on all three strategies.
I have a question for you.
Yeah.
So if I don't have $1,000 to give through my IRA, or that means if I just were to support your organization and give 500, is there any sort of incentive other than obviously giving to a organization, but is there anything else that I can do to get something out of that, of donating just 500?
Yeah, so yes, we get $500, that's good. You gave $500, which, you can feel good about that. You have to remember to mark it down. Now, the answer in June would have been no, because you probably take a standard deduction, and so then you wouldn't get any benefit. But as of the bonus, which we can turn the page to, donating from a checking account. Now, we use, what do we use? We use some systems where you donate from your credit card. that applies here as well. I probably got a little too specific by saying checking account, but donating money that is yours to us. When you go do your taxes at the end of this year, or actually spring of next year, you'll have to say, I did a cash donation. And hopefully the TurboTaxes will update it, us tax preparers, our software will be updated. We'll know to do that outside of your standard deductions. Again, 80 to 90% of people take the standard deduction. Those people are not itemizing anymore. A person who is not married gets higher tax rates. So it's even more beneficial for some younger people in their life to get those tax benefits. So what do we have here for donating from a checking account? Again, using your credit card online, they're giving that kind of cash donation that you're making. The new tax bill just passed, allows cash donations in addition to taking the standard deduction, up to $1,000 for single filers, $2,000 for married filing joint. Married filing single on this one, that's where a married couple decides that they're each going to file their own taxes. It's the same as the single filers. And we've already talked about it, but cash donations only get this benefit.
And it's a deduction.
It's a deduction, yeah, it's not a credit. Go ahead.
Yeah, so can you explain the difference? What that means?
Sure,
Yeah.
sure, so, we're gonna define the difference between a tax deduction versus a tax credit. On a tax deduction, let's say you get to deduct $1,000 from your taxes and you pay 1/3 of your money in taxes. 1/3 of the $1,000 is $333. So your benefit is that your tax bill is reduced by $333. That might mean that your tax refund goes up $333. Tax credits are way better because they count as that towards the actual tax. So if you get $1,000 tax credit, that means the amount of tax due, tax bill, is $1,000 less. If you're getting a tax refund when you file, your tax refund goes up by a full 1,000. And that's actually a way to circle back to that initial conversation here. If we could get tax credits for this, that would just be the government directly funding our program. With the tax deduction, it's partial and partial. Maybe we should all be for more credits.
And so of course, this means like you don't have to give 2,000 to one organization, it's simpler, but anything you give up to 2,000
That's
is a
right.
deduction.
And as a tax preparer, the way I would say that is maintain your receipts. Keep those for 7 years in case of an audit, you may be asked. But yeah. All right, let's go and go to the thank you slide because I'm gonna iterate the same thing I've said throughout. Please remember to work with your tax professional. I am not in business doing taxes with the public. I prepare for a different person who has his own business. So I'm not soliciting for clients here, but I suppose maybe I'm soliciting for the industry. When you work with a tax professional, you're not really paying for them to fill out the paperwork. In fact, every company I've ever worked with as a preparer, the clients do just as much work preparing what we're gonna fill in. What your tax preparer does is sort of back you on the decision making. And then if the IRS does an audit, they're auditing both of you, not just you yourself. If you're doing advanced strategies, these you could probably do on your own. But in general, if you're doing advanced tax planning, it's probably worth the money you pay your CPA or your tax professional. It's sort of an industry advertisement, I suppose. I am happy to answer anybody's questions. I'm the treasurer with 350 Sacramento. I'm not going to take liability for it. I will share with you the information that I have, and I will repeat, as you already have seen, work with your tax professional because your situation may vary. The handout, again, is really meant for you to fill in what you are thinking and then have that conversation with your tax professional. And then the other thing I'm always happy to do is speak with your tax professional. So, okay, maybe you take it something to them and they don't quite understand some way I've worded it or whatnot. I want to help people do this. Be part of 350 Sacramento, I want to help 350 Sacramento.
I'm the oldest person here, so I'm asking the most questions. So I'm 64 right now, the age is 70 and a half to do the required minimum distribution. Can you say again when it's gonna go up or how?
Yeah, let me go back to that slide. So required minimum distributions right now start at age 73. Not fast enough on the math, you're born after 1960?
Yeah.
So everybody born after 1960 is going to be age 75. For the required minimum distribution, when the government forces you to take your money out, that's gonna be age 75 for you, age 73 for people currently. The qualified charitable distribution has stayed at 70 and a half, which is the way the rule was 6 or 7 years ago. So now let's suppose a person is 71, 72 years old, and they want to donate to 350 Sacramento. That would be a situation where they actually pull money out that they're not required to,
Oh,
and it does not count towards income. So no Medicare impacts, no Social Security taxability impacts, stay in your lower tax brackets. So there's a window there of about 2.5 years now, maybe 4.5 years worth of people that could donate more efficient to us. Yeah, I'll say my email here, daniel@350sacramento.org. Any other questions, comments?
I think the other question probably covered it, but if you donate like a little bit to the same organization for the year, it's up to the $1,000 that can be added to your standard deduction.
That's right, that's right. So if you're on a $50 a month contribution to 350 Sacramento, so you do need receipts when you claim these on your taxes. And if somebody, let's say they're single, but they're doing $100 a month, when you do your taxes, don't do the 1,200. Imagine the software is gonna let you know, but just make sure you don't go over the 1,000.
You can donate over the
You
1,000, you
won't
just
go-
don't get the,
Yeah,
okay.
and this starts July 2025, so we can't think about the past 6 months. Or was it retroactive?
I think you got me on this one.
Oh, sorry.
I don't know.
Uh,
Generally, the way these things go, I mean, there are some tax law changes where it would change people's behavior. And they specify the specific date if you did this after this date or before this date. My reading of this one has not brought that question to my mind, but I don't have that answer ready.
Sorry.
Good question.
Does anybody else have questions that I know the answer to? No, but they're good questions and then.
Thank you.